How to build the best investment portfolio for 2023. A period of recession appears to be unavoidable for the world economy, with the contributing factors ranging from an extremely high interest rate by central banks to imbalances in the energy market. There is no doubt that proper planning is the only way to build the best investment portfolio possible for the coming year. Anything less could result in a financial disaster. Do you know how many experts expect the economy to slide into a recession in 2023? How prepared are you? This year could actually be your best so far, only if you are ready for the opportunities that would present themselves. In today's video, we will reveal the investments that should be in your portfolio and opportunities you should plan to seize. Subscribe and stay tuned so you never miss out. In 2023, one strategy would still remain golden, and that is having a diversified investment portfolio. This doesn't mean going out to buy any and everything in hope of a good return. Instead, it means you must understand how to choose an asset allocation strategy that best fits your unique investment objectives and risk tolerance. It takes more than just selecting a few blue-chip stocks and letting them ride to build a viable long-term investment portfolio. Neither is there a ready-made combination formula that ensures a successful one. In this video, we will be going over a few general principles that can help you get started on the right track and how you can make the best asset allocation for your investment portfolio. Although creating an investment portfolio may appear complicated, it does not necessarily have to be so if you know what you want. An easy way to start is by determining your financial objectives. Your specific goals, as well as your age, will help you decide whether to invest your money in short-term or long-term investments. This will also predict the kind of portfolio that you would best need to meet your needs. The bottom line is that a portfolio designed to provide income during the next 5 years will differ from one geared for retirement. Just as the portfolio of a recent college graduate who is just starting a career would differ from that of a family man with more responsibilities. Identifying your risk tolerance is also crucial. If you are risk-averse, you will be super cautious about risking your money in hopes of reaping potential advantages. An easy way to know your risk tolerance level is to ask yourself this question. Can I keep calm seeing my portfolio value drop by, say, 25% on a bad day without panic selling? Yeah, that's a tough one. Everyone surely wants to earn big returns year after year without wanting to take some risks. If you are the type who finds it difficult to fall asleep when your investments experience a temporary decline, then you should invest your money in assets with low volatility. If you are, however, certain that you have a high tolerance for risk, then you are willing to take more chances in the hopes of reaping higher rewards. Whatever your choices, do your due diligence before you put any money in. After carefully analyzing your financial goals and your risk tolerance, the next thing you have to do is to honestly evaluate your investment abilities. This will help you determine whether you can create a portfolio on your own or if you would require the input of a financial advisor. Fortunately, there's a lot of professional advisory services even for small investors. There are different types of investment portfolios you can adopt, but there are two major ones to consider as they revolve around the investor's level of risk tolerance. Even their names say it all, as they are called the aggressive portfolio and the conservative or defensive portfolio. An aggressive portfolio is particularly suited for investors with a high tolerance for risk. These investments usually come with insane risk levels, but they also have the potential to provide substantial profits. When compared to the market as a whole, they are more volatile and their prices are subject to greater fluctuations. A good example is high beta stocks such as Advanced Micro Devices and United States Steel. A conservative portfolio, on the other hand, is for those with a low appetite for risk. Buying shares of companies that will always be in operation is a common strategy for constructing a defensive portfolio, as these businesses produce goods that are essentially needed for daily human survival. In general, the more risks you are willing to take, the more aggressive your portfolio will be, as you will want to invest more in stocks and less in fixed income investments. Conversely, a defensive portfolio is all about maintaining value. Now that you know the general factors to consider and the forms of investment portfolios you can build, what's next is to start building the portfolio. At this stage, you will have to decide on how much of your money you are willing to put into each asset and how you intend to balance your portfolio to boost your diversification as time goes on. You can choose the investments and securities to execute your asset allocation plan in different ways, but always keep in mind to evaluate the worth and potential of any asset you invest in. Asset classes you can invest in including any of the following. First is stocks. There is a reason why stocks are the most popular asset class, as they should be major in an investor's portfolio. Buying stocks makes you a partial owner of the business, so it's important that you select a stock from a business that you understand and one with a competitive advantage. This asset class is the most time-consuming. It demands constant monitoring of price fluctuations in your investments, as well as keeping up with business and industry news. It, therefore, goes without saying that you should only invest in stocks based on your known level of risk, while keeping its effect on your portfolio in mind. Factors you can consider when buying stocks include the market cap, industry sector, stock type, etc. Another asset you should own are bonds. Bond investments can be tailored to your specific income requirements. You should consider the overall interest rate, credit rating, coupon, maturity period, and the like when choosing bonds. Can I be completely honest with you though? If you are currently or will soon start depending on the profits of your investments to cover your bills or other expenses, then including bonds in your investment portfolio is the best way to go. In fact, it's recommended that a portion of the investments in any investment portfolio should be allocated to bonds. This is because bonds offer consistent and generally secure cash flow or income, which is essential for investors in various stages of capital preservation. You may also want some exchange-traded funds or ETFs. ETFs combine the best two features of well-known assets. They imitate the simplicity of trading stocks while offering the benefits of diversification that comes with mutual funds, which I will be explaining soon. ETFs are a collection of securities, like bonds or equities, that give you the flexibility of making many simultaneous investments, and they come in handy when rounding out your portfolio. This asset class also frequently has cheaper costs than any other type of funds, in addition to the ease at which it can be traded. As simple as they may appear, you must ensure to examine them based on their individual qualities, taking into account management fees, commission charges, ease of purchase and sale, ability to fit into your current portfolio, and investment quality. Mutual funds are also good investments you should consider. A mutual fund is a group of securities that are owned by investors and overseen by a fund manager. Retirement or long-term investors usually include this asset class in their investment portfolio. This is because one mutual fund can give leverage on hundreds of stocks, bonds, and other investments, making them a relatively hands-off option to invest in multiple assets at once. Investors who don't want to choose individual investments but would like to take advantage of the stock market's historically strong average yearly returns frequently use this investment strategy. Although mutual funds and ETFs are similar in some ways, there's a key difference between them. ETFs can be exchanged throughout the day like stocks, while mutual funds can only be bought at the close of each trading day, based on a price calculation known as the net asset value. After deciding on how you want your portfolio to be, you should periodically review and rebalance it due to the possibility that changes in price or value can necessitate an adjustment on how you've allocated your capital. Another thing that can call for a review of your portfolio is a change in your risk tolerance. For instance, you might need to cut back on the number of stocks you have if your risk tolerance has decreased. Bear in mind that the risk-return profiles of different assets differ. Stocks, for instance, have historically offered the best long-term returns but are susceptible to short-term volatility. Bonds, on the other hand, offer a smaller long-term return than stocks, but they are less volatile. The two, therefore, can be combined with other asset classes in different ratios to produce a wide range of risk-return profiles that are suitable for various investors. On a final note, always remember that an investor's behavior can make or break a portfolio. Whether investors act logically or irrationally, it can frequently have a significant impact on their long-term returns. As you move along in building your investment strategies for the coming year, ensure to adopt the right investment behaviors, which can be summarized into 3 rules. You can even turn them into your motto so that you can easily remember them. The rules are: avoid timing the market, avoid a constant rebalance of your portfolio, and avoid relying on past performance. Remember, the final decision is yours. You must do your due diligence. This video is for educational purpose only. If you learned something new, subscribe to the channel and give this video a thumbs up.